And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to you about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might actually find this interesting, I know that's a shocker, but you can just go ahead and share it with them as well. So today I'd like to take a step back and I'd like to speak about some investing basics, defining some terms, what we call like asset classes, speak about different asset classes. Those are different things that you can invest in. And starting from sort of the most conservative of those assets up until stocks. I'm not going to get into wild things. I'm not going to speak about Bitcoin or whatever, but sort of 3, 4, 5 basic asset classes from conservative on up to more aggressive, more growth oriented, so that beginning investors can really understand what it is that they're doing. I often see people who come and they have no concept of what they hold in their portfolio. There's always a disconnect. I just spoke with somebody literally maybe 2 days ago who was doing things themselves. They were a do-it-yourself investor, and they were telling me how conservative they were. And they had a stock, their portfolio was just loaded up on individual stocks, right? And most of them were high-tech companies. So I said, there's a complete and total disconnect between what you're telling me and what you have. So that sort of inspired me to give a little tutorial, just take a step back so that people really understand what it is that they're investing in. So let's start off with the most famous of all investments, cash. Cold, hard cash. We like cash. So a cash bank deposit is the simplest, most easily understandable investment, and it's probably the safest. It not only gives investors precise knowledge of the interest that they'll earn, but also guarantees that they're going to get their capital back. On the downside, and this is important, right? The interest earned from cash socked away in a savings account seldom beats inflation. CDs, which are certificates of deposit, are slightly less liquid than cash, but they typically provide higher interest rates than you're going to get in a regular savings account. The money put into a CD is locked up for a specific time period, right? It could be from months to years, right? 30 years, 40 years, and it could be from, a month forward. There can be, if you're doing it through the bank, early withdrawal penalties involved if you buy a 10-year CD and you need the money. Now, if you do it through a brokerage firm, and I don't want to complicate things, just so you know, what are called brokered CDs actually trade. You can sell them. There's a market from them. You sell them at the price of the market. That might be higher or lower than your purchase price, but you will have gotten all the interest which is accrued up until that point, and then you sell to the market price. It's not exactly like if it's in a bank and then you break it, there oftentimes you'll lose whatever interest, and you'll pay a penalty for early withdrawal. So that's cash, right? Comes in the form of regular savings account, or you can put it into certificates of deposit, which often are insured up to $250,000 by the FDIC. Next on the list, we have what are called bonds. Bonds are basically loans. It's a debt instrument. It's a loan made by an investor to a borrower. A typical bond is going to involve either a corporation or a government, right, trying to raise money. So they'll issue this loan, this debt, and they'll say, for example, we want to raise $1,000 and we're going to give you 5% interest. And in 3 years, we're going to return the money to you. And along the way, you're going to get 5% along. That's called a coupon. You're going to get that 5% every year. Bonds are commonplace in organizations that use them to finance operations, purchases, or other projects. This is where it gets a little tricky. Bond rates are essentially determined by interest rates. Due to this, they are heavily traded during periods of quantitative easing or when the Federal Reserve or other central banks raise interest rates. There's what's called an inverse relationship between the price of a bond and its yield. So when the price goes up, means there's more of a demand for the bond. If there's more of a demand for the bond, what ends up happening is the interest rate of the yield is actually going to drop. Conversely, when there's less of a demand for the bond is going to drop in price and you're going to see higher yields on the bonds. Okay, that's already getting more into the minutia, into the weeds, but that's what a bond is. A bond is essentially issued by a government or by a corporation to fund its operations, right? Just a loan that they're giving, right? As opposed to a savings account or a CD from the bank, where the bank is the one who is initiating the loan, giving you the interest along the way, and then using it to fund their operations. Here, a bond is the same thing, same concept, not necessarily insured, but unless it's by the US government, but it's the same principle usually used to fund operations. Okay, next we have what's called a mutual fund. Those have become much less popular in recent years. I'll explain why later. A mutual fund is a pool of money, right? Investors invest in a pool. They invest in a fund. It's not that everything is segregated into the investor's name, but they're part of a greater pool of money. Oftentimes, they're managed by portfolio managers who then, based on the mandate of the fund, invest the money into stocks or bonds or some kind of combination of the two. The advantage, obviously, is that it's managed by professional investors, and they do the buying and selling for you, right? Instead of you having to buy and sell funds, they do it for you. They buy and sell, again, bonds, stocks, or some kind of combination of the two. Because of that, because they are generally actively managed, they have slightly higher, or not so always slightly, they have higher fees, right? Because the manager of the fund and that whole staff, the administration aspect of the fund, right? That's where they are sort of in this chain, the food chain, and they're entitled to make their money as well. So they take management fees, their marketing fees, all these things called 12b-1 fees. They tend to be much more expensive. Oftentimes when you buy funds, they come with what are called loads, which you might pay an upfront fee to buy the fund. If you don't hold it long enough, you might pay a fee to sell the fund. And like I said, there are internal fees along the way, which you pay on an annual basis. There are also what are called no-load funds. So those you don't pay to go in and you don't pay to go out. Those tend to be a cheaper variation, but still those annual management fees do cut in to the investor's returns. Next up, we have what has turned out to be the most popular, at least now, asset class, and those are called ETFs, or exchange traded funds. They've been popular they came online 30 years ago approximately, and they've taken the investment world by storm. They're similar in certain respects to mutual funds, but they trade throughout the day. They trade like a stock, second to second. You can buy and sell, as opposed to a mutual fund, which prices at the end of the day. Most exchange traded funds mirror the market index. What does that mean? So you've probably heard when you turn on the TV at the end of the day or whatever, you heard, oh, the stock market went up by 0.5%. Generally, if you're in the US, that is referring to a market index called the S&P 500, the Standard & Poor's 500 index, which is an index made up of 500 of the biggest publicly traded US companies. These indices help us understand what's going on in the broader market. Keep in mind that stock market's made up of thousands and thousands of stocks. So it's sort of hard to know how everything is doing, right? Not just the stocks you may own, but how the broader market is doing. So there are various indices that have been created. You can track these indices through these ETFs, right? They track hundreds, if not thousands of indices, broad-based indices like the S&P 500 to specific sectors or niches like biotechnology, medical devices, agriculture, and you name utilities, you name it. There's, like I said, there are hundreds, if not thousands of these. They're popular with investors because they are much cheaper than mutual funds. They're a great way to diversify because you own the entire index, because you can take your money and buy 3 or 4 broad-based ETFs and you're good to go. You've basically just created a very low-cost portfolio. Now, the reason they become so popular over time is, I mentioned, because they're very, very, very cheap, number one. Number two, all the data points out to the fact that over 90% of mutual fund managers, portfolio managers, are unable to actually perform better than the index that they're matched up against, the world that they're investing, their benchmark, the world that they have to invest in. So the theory goes, if they underperform statistically and they charge more, that's less statistical. That's pretty much a given. Why bother investing then when you can just buy the index? So the thought process has then evolved into, we can create a diversified, broad-based portfolio using very, very low-cost assets. And at the end, it's sort of the best of both worlds. You end up saving money, and hopefully over time, again, past performance is no indication of future returns, but statistically at least, they tend to outperform. Lastly, we have individual stocks, right? They just tend to be they are more aggressive, right? The ETFs and the mutual funds may be made up of individual stocks, but when you own individual stocks on your own, right, unless you're high net worth, you're not going to be able to buy as many as the mutual fund owners or the managers are going to buy, or that make up the actual index. So by definition, it's going to be a little bit more aggressive. Shares of stock let investors participate in a company's success via increases in stock price and through dividends. Shareholders have a claim on the company's assets in the event of liquidation, i.e. bankruptcy, right, in red letters, highlighted, but do not own the actual assets. Holders of common stocks enjoy voting rights, right, at the annual meetings. If you already own stocks, now you're going to understand, why do I get those? Now it's all pretty much online, but why did I get those envelopes where I had to vote, right? What do I know about what's going on with the board of directors or any other issues they're voting on? Well, because you actually are a part owner of the company, and as such, you are able to vote in any kind of elections that they may have. Most people, unless you're a big institutional investor, don't take the votes all that seriously. I do have actually clients who complain if their annual report book or their proxy, which is what they vote, is delayed a little bit in the mail. I get calls all the time because they take it very seriously. They view it as their right, and they want to use their right to vote as a shareholder. They want to vote their mind, right? And if they like whatever the agenda is, they'll vote yes. And if they don't like the board of directors or what have you, they'll vote no. They take that right very seriously. Obviously, there are a lot of other asset classes, be real estate and private equity and hedge funds. I don't want to get into that. This is sort of like chocolate vanilla, right? Cash, certificates of deposits, bonds, you have your mutual funds, your exchange traded funds, and then you go up to individual stocks. I hope this helped. This was the Investing 101 course with Aaron Katzman. You've been tuning into the Aaron Katzman Show. We speak to you about your life, your money, and your investments. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might have actually gained from this, go ahead and share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.